In November of 1996, the new boss of Sunbeam stood in front of the business press and announced that he was going to fire 6,000 people, half the company. He was closing most of its factories and killing most of its products, and he said it with something close to pride. Wall Street loved him for it. Over the next year and a half, his stock climbed until Sunbeam was trading at $52 a share, and the man who ran it, Albert Dunlap, was the most celebrated executive in America. They called him Chainsaw Al. There was only one problem with the turnaround that made him famous. A large part of it was invented. In 1997, Sunbeam reported a record profit of $189 million. According to the Securities and Exchange Commission, at least $62 million of that came from accounting fraud. When the truth started to leak out, the stock did not drift down. It fell off a cliff from $52 to under $9. The board fired him. The 104-year-old company went bankrupt, and the man who had built a career on cutting other people's jobs was banned from the boardroom for the rest of his life. This is the story of how the numbers, not the man, turned out to be the real fraud. This is Chainsaw Al and the cooking of Sunbeam. Albert Dunlap was born in Hoboken, New Jersey in the summer of 1937. He went to West Point, graduated in 1960, and served 3 years in the Army as a lieutenant. Then he spent the next 3 decades building a very specific reputation. Dunlap was a fixer. Boards brought him into companies that were struggling, and he did one thing better and more ruthlessly than anyone in America. He cut, he closed plants, and sold off divisions. Above all, he fired people in enormous numbers, and he did it fast. The press gave him names: Chainsaw Al the Shredder, Rambo in pinstripes, after a photograph of him with an ammunition belt slung across his chest. He did not resent the names. He collected them. In 1996, he published a best-selling book about his own methods and called it Mean Business. His philosophy was not complicated. He once boiled his entire view of running a company down to a single question: how can we make our stock worth more? He compared himself, without embarrassment, to Michael Jordan and Bruce Springsteen, fellow superstars. He wrote a magazine column that was, in one description, gleeful about how wonderful mass firings were for shareholders. And for a while, the numbers backed him. At a company called Lily Tulip in the 1980s, he ran the stock from under $2 to more than $18. To Wall Street, he looked like proof that a hard enough man could always force value out of a soft company. The performance that made Dunlap a household name came at Scott Paper. He took over the old paper goods company in 1994, and he did what he always did, only bigger. He fired roughly 11,000 people, about a third of the workforce. Then, in 1995, he sold the slimmed-down company to Kimberly-Clark for around $9 billion. For Dunlap personally, the sale was a fortune. His stock and options were worth roughly $100 million. To his critics, that number was obscene: $100 million for 18 months of firing other people. Dunlap thought the criticism was foolish. He called the payout modest. Set against the $6 billion in shareholder value he said he had created. That was the chainsaw method in one sentence. The people who lost their jobs were a cost. The rising share price was the only scoreboard he recognized. And in the summer of 1996, a struggling appliance maker in Florida decided this was exactly the man it needed. Sunbeam made toasters, mixers, grills, the ordinary machines in ordinary American kitchens. By 1996, it was drifting, and the board wanted a shock. In July, they hired Dunlap as chairman and chief executive, brought in to rebuild a company in trouble. He moved fast. In November, he laid out the plan. Half of Sunbeam's roughly 12,000 jobs would be gone, about 6,000 people. 3,300 as product lines were shut or sold. 2,100 as 6 factories closed. The rest from the offices and the headquarters. He would take the number of plants from 26 down to 8. He would kill 87% of the company's products. He would shrink the warehouses from 61 to 24. He described the company he had inherited in his usual style. It was, he said, a plan for total disaster. The company, as it was going, he told reporters, would have been out of business in 18 months. In return for the bloodletting, he promised to double sales to $2 billion and push the operating margin from 2.5% up to 20%, all within 3 years. Wall Street did not flinch at the human cost. It cheered. This was Chainsaw Al doing the only thing Chainsaw Al ever did, and the stock began to climb. For about 18 months, Dunlap was untouchable. The 1997 numbers looked spectacular. Sunbeam reported that record profit of $189 million, a stunning swing for a company that had been bleeding red the year before. Analysts wrote glowing notes. The stock kept rising. The man who wrote Mean Business had apparently proved his own thesis all over again. By early 1998, Dunlap decided Sunbeam was strong enough to go shopping. In March, he announced 3 takeovers at once: the camping brand Coleman, the maker of Mr. Coffee, and the smoke alarm company First Alert, a package worth around $2.5 billion. The Coleman deal brought in one of the sharpest investors in America, Ronald Perlman, who agreed to sell Coleman to Sunbeam for $2 billion and took almost $1 billion of that in Sunbeam stock, then trading around $45 a share. If a man like Perlman was happy to hold the shares, who could possibly doubt them? In March 1998, Sunbeam hit its high, $52 a share. Forbes magazine, watching the drama build, would later give the whole affair its perfect name: the Sunbeam soap opera. Nobody yet knew how the season ended. Here is how the miracle actually worked. According to the Securities and Exchange Commission, from the last quarter of 1996 until the middle of 1998, Dunlap and his chief financial officer, Russell Kirsch, built what the agency called the illusion of a successful restructuring. The purpose was to lift the share price and make the company worth more, either to investors or to a buyer. The first trick was the reserves. When Dunlap arrived at the end of 1996, Sunbeam set aside about $35 million in restructuring and other reserves, far more than it actually needed. That deepened the loss in 1996, the year everyone already expected to be ugly. Then, through 1997, the company quietly fed those reserves back into its accounts as profit. The SEC put it bluntly. Management had falsely created the impression of massive losses in 1996 to make the next year look like a dramatic turnaround. There was more. Sunbeam booked what accountants call bill and hold sales, recording revenue for goods that were never shipped and just sat in a warehouse. It stuffed the channel, pushing retailers to order winter grills in the spring by pulling future sales into the present quarter. It even counted revenue on contingent sales that could still be cancelled. When investigators added it all up, the verdict was devastating. Of the $189 million in income Sunbeam reported for 1997, at least $62 million came from accounting fraud. The record year was, in large part, a fiction. A machine like this can only run in one direction. If you pull next quarter's sales into this one, then next quarter arrives with the shelves already emptied. For a company selling toasters and grills, the seasons themselves became the trap. Grills sell in summer. To make an earlier quarter look bigger, Sunbeam had to talk retailers into ordering summer stock in the dead of winter at a discount. And once a store has bought its next 6 months of grills, that store does not order again for 6 months. The growth was not growth. It was a loan taken out against tomorrow, and tomorrow came due. By the spring of 1998, the cracks were showing. Then a report appeared that the SEC had begun looking at the company's accounting. The reaction was brutal. The stock that had touched $52 in March collapsed. In a single day of heavy selling, it lost roughly a fifth of its value. By June, it was trading, according to Forbes, at $8.81, from 52 to under 9. The soap opera had reached its turn, and Chainsaw Al was suddenly the one on the block. On the 13th of June, 1998, the board of Sunbeam fired Albert Dunlap. The great cutter had been cut. A new chief executive, Jerry Levin, took over a company that turned out to be far weaker than its famous boss had claimed. The auditor through all of it had been Arthur Andersen, the same firm that would later die alongside Enron. Its engagement partner on Sunbeam, Philip Harlow, would be named by the SEC as well. Then came the accounting for the accounting. Sunbeam restated its books, and the restatement erased much of the miracle. Net earnings for 1997 came down by around $70 million from what had first been reported. The record year shrank back toward the truth. The damage spread outward. Ronald Perelman and the investor Michael Price together lost around $1 billion. Perelman alone, more than $600 million. All told, shareholders were estimated to have lost somewhere near $4.5 billion. The company itself never recovered. Buried under the debt from Dunlap's own buying spree, a 104-year-old business finally filed for bankruptcy in early 2001 in the Southern District of New York, carrying roughly $1.7 billion in bank debt alone. Sunbeam, the name stamped on 1 million toasters, was finished. So what did the law do with Chainsaw Al? In May 2001, the SEC sued him. The complaint, filed in federal court in Miami, named 6 people: Dunlap, his finance chief Kirsch, the controller Robert Gluck, 2 other executives, and the Arthur Andersen partner. The agency laid out the whole toolkit in plain language: cookie jar reserves, improper bill and hold transactions, recording revenue on contingent sales, accelerating sales from later periods into the present. The settlement came in September 2002. Dunlap agreed to pay a civil penalty of $500,000 and to be barred from serving as an officer or director of any public company for the rest of his life. As is usual in these deals, he neither admitted nor denied the charges. Kirsch paid $200,000 and took the same lifetime ban. There was more money elsewhere. In the shareholder lawsuits, Dunlap paid $15 million out of his own pocket, and Arthur Andersen paid $110 million as part of a larger settlement a judge approved in the summer of 2002. None of it counted as an admission of guilt. Add it up from Dunlap's side: a $500,000 fine and a lifetime bar set against the fortune he had already built, cutting companies to the bone. For the man who invented $62 million of profit, the government's price was $500,000. Albert Dunlap never ran a public company again. The lifetime ban held. He kept his money and his houses, gave some of it away, and settled into a long retirement in Florida. He died in Ocala in January 2019 at the age of 81. He left behind a warning that took years to be understood. When Dunlap was cooking Sunbeam's books, the great accounting scandals still had names nobody had heard yet. Enron, WorldCom. Sunbeam came before all of them, one of the first big American frauds of the late 1990s, and it ran on exactly the same fuel. A worshipped boss, a stock that could only go up, and a set of books quietly rearranged to keep the story alive. The chainsaw legend was always about the man, the tough guy who fired 6,000 people and made the market applaud. But look again at what actually broke Sunbeam. Not the layoffs, the reserves, the bill and hold sales, the $62 million of profit that was never earned. In the end, the real fraud was not Chainsaw Al at all. It was the numbers standing behind him. The company is gone, the nickname survives, and Sunbeam is still a clean early lesson in a rule the next decade would learn the hard way. When a turnaround looks too good to be true, check who is holding the pen. This has been Cooked Books. The archive is open.